Hi, Kyle Odell here. I want to talk to you about a couple of expectations that I think are very important having going forward when it comes to the stock market. So one area I'd like to talk about is the risk that's in the market and when does the market typically pull back? I want to hit on that piece. The other is baseline expectations that you should have when it comes to the stock market. And then number three, if the market does drop, what are some things you can do to take advantage of that? So number one, risk. If we look back over the last 20 plus years, whenever the market has taken a big drop, it's because of a surprise. If we think about the stock market over the years, the market is forward thinking. So we're looking at, right now, one of the big concerns is that taxes may go up and that there may be some changes to estate planning. And we think about Social Security and all those things. The stock market is forward thinking on all those. When the market has pulled back and had a big drop, it's because of a surprise. So let's think back. We go back to 9/11 back in 2001, right? We also have the 2008 housing crisis where there were collateralized debt obligations that those came about. And with all that, we have the stock market drop there in August of '08 where the market dropped significantly. We have in 2020 the coronavirus. The market doesn't like surprises, and that's what causes the market to take big drops. So when that does happen, I think that overall what we need to have are baseline expectations. Yes, here at EdgeRock, some of our portfolios are managed defensively. We work to try to avoid significant drops in the market with no promises, but we work to try to do that. But a lot of those drops on an annual basis, we're going to ride those out. And if we look here, I know this might be a little small, and I'm happy to send this to any of you. If you email our office at DTC@EdgeRockWealth, we're happy to send this slide out to you. But on an annual basis, the market will drop, in '08, drop 49%, in '09, 28%, 16%, 19%, year after year after year. The market takes a drop almost every year of at least 10%. That's normal. And when that happens, we're typically going to ride that out. When it comes to the tactical measurements of our portfolios where we're managing them defensively, all we're attempting to do there is if the market takes a significant drop, 20 and 30%, that hopefully we're going to avoid some of that drop. That's our primary objective, again, with no promise. That's difficult to do, but we work very good. I think our portfolio management and so forth, we've done a good job on that piece of it. Now, what are some expectations? Number one, I would have an expectation that most years the market's going to drop by at least 10% at some point. Number two, over any 10-year period, over any 10-year period, any decade, the market is typically going to drop twice by at least 20%. That's what we call a correction. That's normal. And so with that, a lot of times, we want to manage our assets the right way through that. That's having the right portfolios in place and so forth so that we can manage through it. But whenever that happens, what are some things you can do to take advantage of it? Number one, if you're still working, if you're contributing to a 401k that allows you to, if you're contributing to that 401k and the market drops, then you're buying the market when it's down. That's a great thing. You're getting shares at a lower price. Number two, if you're in a position to do Roth conversions, if the market drops, that's a great time to do a Roth conversion because your account has a lower value and hopefully it's going to bounce back later. Let's do that Roth conversion at the lower value. Number three, if you have non-IRA assets, so non-qualified accounts and the market takes a drop, it's a great time a lot of times to sell that stock at a depressed value or maybe even a loss. And the key is if you can do it at a loss, that's called tax loss harvesting. Let's say I own Apple stock and my stock drops and now it's worth less than what I purchased it at. So let's say I bought it at $100,000, it went up in value, but now it's dropped down to $90,000 in value. If I sell it at that point, I can lock in that tax loss of, if you will, of $10,000 and apply that in the coming years to my tax return. But I can turn right back around and sell and buy that back at $90,000 and let it ride back up. But what I've done is I've locked in a tax loss that I can apply to my taxes in the coming years. These are strategies that our advisors can talk you through. If you have more questions about it, happy to discuss these with you. Reach out to us at DTC@EdgeRockWealth.com. Again, Kyle Odell, let us know how we can help. Thank you very much.